Welcome back as we complete our final video with respect to the income statement in the series dealing with our income statement for the Tuff Tank Incorporated question, which is a published account question. And we know that companies are publishing their financial statements, and persons who would be interested in those published financial statements will be persons such as shareholders, investors, potential buyers, creditors, financial analysts, the financial press. Various persons will be interested in those financial statements of these companies who are either public or private companies. So we are continuing with our income statement, and we have already calculated our gross profit by taking our turnover and subtracting our cost of sales from it to give us our gross profit of $77,295. So we have gross profit $77,295, and from our gross profit we subtracted our administrative expenses and our selling and distribution expenses, which gave us an operating profit of $16,690. Remember, these figures here were subtracted from the gross profit. So now we want to look at any interest that was paid or any interest that was received. So we know that from our question that we have a bank loan or 6% bank loan of $40,000, and from previous accounting classes we were told that whenever you have a loan, you must calculate the interest on that loan because the interest must be paid on the loan before looking at our final profit. However, when we look at our trial balance here, we see that we have interest already paid of $1,600. So although there's interest showing here of $1,600, we are not sure if this is the correct amount of interest that should have been paid for the year. But we know that this is the amount that Tuff Tank paid in their interest because it is on the trial balance. So what we need to do is to calculate 6% of this bank loan. But let's see that we had some additional information with respect to the bank loan. It states that the loan transaction took place on November 1st, 2015. And if we go back to our financial statement, we will recognize, if we go back to the question, to the beginning of the question, we will realize that our financial year for this business ends on June 30th, 2016, which meaning it starts on July 1st, 2015. So if it starts on July 1st, 2015, we have July, August, it starts on July 1st, 2015, ends June 30th, 2016. And the questions told us additional information say that whatever we got the loan, the transaction that happened with respect to the loan was on the 1st of November 2015. So we cannot calculate interest on this loan for a full year because we didn't have it at the beginning of the company's financial year. We have to calculate interest on the loan from the time we would have acquired that loan in the first instance. So we acquired on November 1st to the end of the financial year, which is June 30th. So let's see how many months we have that interest, that loan for. That will be November, December, January, February, March, April, May, June. 8 months. So we have to calculate an 8-month interest. So let's go back to the question. So our loan, let's look at while we were on our break, I calculated the interest on the loan. $40,000 times 6% times 8 on 12, which gave us $1,600. And we would have seen that inside of the trial balance, it showed that we paid $1,600 for our interest. That means the exact amount that we were supposed to pay for the year is what we would have paid for our loan interest. So let's put our loan interest. So that's subtracting our loan interest. So let's go. So we are going to less interest, which was paid, and that is $1,600. And in our question in the trial balance, we also realized we received interest. Not sure what we received the interest from, but we received interest. Maybe we could have received it on our bank balance, but we got some interest, and that interest was $400. So this is money coming in, so that's additional revenue. So therefore we are going to add that. So we're going to add interest received. So the first one is interest paid, $1,600, and our interest received is $400. So let's see what our profit is before taxation. So profit before taxation. So we're going to be starting here our operating profit now. So that would be our operating profit of $16,690 minus our interest paid of $1,600 plus our interest received of $400. So we have profit before taxation of $15,490. So our profit before we paid any taxes, $15,490. Remember, this is a company, and companies must pay taxes on their profits. So therefore, that must be calculated and paid to the relevant authority in government. So let's see what the question tells us about our taxes. Sometimes a question will give us a percentage and tell us that we have to calculate our taxes based on a percentage of the profit that was made. However, in this question, in note number 6, additional information number 6 told us that corporation tax of $3,220 is to be charged for the year. So that's the taxes that's supposed to be charged for the year, and this is what we will put in our income statement as our tax, our corporation tax. So it's less corporation taxes of $3,270. So this is going to be subtracted from our profit before taxation. We're going to subtract our corporation taxes of $3,270, and that will give us our profit after taxation. Okay, so that will give us our profit after taxation. So that will be $15,490 of profit before taxes minus whatever taxes we're supposed to pay of $3,270, and that gives us a profit after taxation of $12,220. So this completes our question, where we have now our income statement. You can see here, very short, very condensed. Turnover minus our cost of sales give us our gross profit, and our gross profit minus our administration expenses, selling and distribution expenses give us our operating profit of $16,690. Then we paid our interest, and we subtracted the interest we paid from that profit, and we add our interest received to that profit and got profit before taxation of $15,490. and then we took out the taxes that we were supposed to pay of $3,270, and we have profit after taxation of $12,220. Now, for a company, you will have to go on and prepare something called a statement of changes in equity, where you look at how you appropriate this profit. You add the profit that you would have had before to it. If there was a loss, you would subtract that from it, and then you would subtract any dividends that were paid or any reserves that would have been transferred during the period. And also we would have you would need to do additional notes to calculate on any dividends that were proposed but are recommended to be paid but not actually paid during that year. However, this question, when we look at this question, we have in the additional information, it doesn't tell us anything about dividends being paid. It didn't tell us anything about any transfer to any special reserve, because that is a fund that the business is keeping to do additional stuff. There's no transfer to reserves, and the only thing we have on our statement of financial position showing that the company made a profit previously of $14,200. So in this question, we will not be doing a statement of changes in equity. So basically, this completes the statement of the income statement for Tuff Incorporated, suitable for publishing. So this is a publishing format. This format is suitable for publishing, and sometime in the future, we will look at preparing the statement of financial position for this question, and we may look at a statement of changes in equity for a completely different question, where then you can see my demonstration of how to prepare that statement of changes in equity using the format that we usually teach. Okay, so this brings us to the completion of the final video in this series in terms of preparing the income statement for Tuff Incorporated. So I would like you to like this video, share this video with your friends, and subscribe to my YouTube channel. Thank you.